How much house can you actually afford? The Zillow-scrolling ritual. You know the ritual. It's 11 o'clock at night. You should be asleep, you have work tomorrow, and yet here you are, lying in the dark, phone 6 inches from your face, hate scrolling Zillow like it's a second job. 4 bedrooms, hardwood floors, that kitchen island you've been redesigning in your head for 3 years. The yard big enough for a dog, maybe a garden, definitely a place your kids can actually run around. You tell yourself you're just looking. You're not looking, you're dreaming. And then, because you can't help yourself, you tap over to the mortgage calculator. You plug in the numbers, and then your stomach drops. That feeling you just had, that's not you being bad with money. That's not you lacking ambition or discipline or financial literacy. That is the cruel structural math of the 2026 housing market doing exactly what it was designed to do, making you feel like homeownership is permanently one salary raise away. $83,730. U.S. median household income 2026. $23,000. How far short the typical family falls from what's needed to afford a median-priced home. Here is the number nobody is putting on a billboard. The typical American family earning a median household income of $83,730 is approximately $23,000 short of the annual salary needed to comfortably afford a median-priced home today. $23,000. That's not a rounding error. That's the gap between a generation that was told to just work hard and save and a market that moved the goalposts while everyone was looking away. The rules that governed American housing for the last 40 years, buy early, stretch a little, watch it appreciate, have been rewritten. Interest rates, prices, inventory, wages, the entire equation changed, and most of the advice floating around the internet hasn't caught up yet. So today, we're going to build you a real framework. Not the lender's version, not the optimistic estimate from the mortgage broker who makes money when you sign. The actual math. What you can afford, what it'll cost you if you overshoot, and most importantly, the 3 specific levers you can pull to change your outcome.
Approval versus affordability, the lender trap. Let's start with the most dangerous number in real estate. And I promise you, it is not the listing price. It's not the interest rate. It's the pre-approval amount. Here's what happens. You go through the pre-approval process, the lender pulls your credit, looks at your income, evaluates your debts, and then they give you a number. Let's say $480,000, and that number feels incredible. It feels like validation, like the bank looked at your entire financial life and said, you deserve this. What they actually said is, we have calculated the maximum amount we believe you can repay us before defaulting. Those are not the same sentence. The metric lenders use is called the debt-to-income ratio, your DTI. It's the percentage of your gross monthly income that goes toward debt payments. And most conventional lenders will approve you at a DTI of 43% to 50%. Some will go higher with compensating factors. That sounds manageable on paper until you do the math on what 43% of gross income actually means for your life. Because gross income, that's before taxes, before your 401k contribution, before health insurance, before every single deduction that happens before you see a dollar of your paycheck. 43 to 50%. DTI ratio lenders will frequently approve. 51% plus of your actual take-home pay consumed when spending 40% of gross income on housing. When you're spending 40% of your gross income on a mortgage, you can easily be sending over half of your actual take-home pay to your lender every single month. More than half. That means every other line item in your life, food, transportation, childcare, savings, retirement, emergencies, is competing for less than half of what you bring home. That's not a mortgage. That is a life sentence with a 30-year maturity date. So what's the right number? Financial planners have had an answer to this for decades. It's called the 28-36 rule, and it's the closest thing we have to a universal guardrail for affordability. 28%. Max housing costs, PITI, as percent of gross income. 36%. Max total debt as percent of gross income. The first number, your total housing payment, principal, interest, taxes, and insurance, everything bundled, should not exceed 28% of your gross monthly income. That's the PITI number. That's what you're targeting. The second number, all your debt combined, mortgage, car loans, student loans, credit cards, should stay under 36% of gross. That's your ceiling.
The space between 28 and 36 is the only room you have for every other debt obligation in your life. If that space is already eaten by a car payment and student loans before you ever get to a mortgage, your purchasing power just shrinks significantly. Most lenders will let you blow past both of these numbers. They're in the business of originating loans. Your long-term financial health is not their primary concern. It's yours, so you have to hold the line yourself.
The salary reality check. What you can actually buy. Okay, enough theory. Let's get ruthlessly specific. I'm going to run 3 income scenarios using a consistent set of assumptions. 6% interest rate, 10% down payment, the 28% gross income rule as our ceiling. No creative accounting, no optimistic scenarios. Just the math as it actually exists right now. These scenarios are going to make some of you uncomfortable. Good. Comfortable assumptions are what got people into 50% DTI mortgages they can barely survive. $50,000 income, around $165,000 to $175,000 home. At 6% interest and 10% down, a $50,000 salary puts your comfortable price range between $165,000 and $175,000. Let's be honest about what that means geographically. Pittsburgh, PA, Dayton, Ohio, Wichita, KS, Dallas, Texas, Charlotte, NC, Phoenix, AZ, every coastal city. At $50,000 a year, you are priced out of virtually every major metro in the country. You're not priced out because you made bad choices. You're priced out because median home prices in most large cities now exceed $350,000 to $400,000. The math simply doesn't work. Your options are small towns, rural markets, and a handful of Rust Belt cities that are still genuinely affordable, which, by the way, are underrated if remote work is an option for you. We'll come back to that. $100,000 income, around $350,000 to $370,000 home. A 6-figure salary puts you in a range of $350,000 to $370,000. This feels like a lot until you start looking at where that buys you a home. Indianapolis, IN, Kansas City, Missouri, Columbus, Ohio, Denver, Colorado, Seattle, Washington, Miami, Florida, Austin, Texas. Here's the ego check moment for a lot of people. A 6-figure salary in 2026 no longer buys you access to America's economic engines. Denver, Seattle, Miami, Austin, all of them require incomes well above $100,000 to hit our 28% target on a median-priced home. You're relegated to the middle of the country, which again is more interesting than it gets credit for, but it's not where most people planning their careers want to land. And let's talk about the psychological weight of that for a second. You worked hard, you went to school, you built skills, you got to $100,000 a year. That used to mean something in the housing market. It used to open doors. Now it's the baseline requirement to buy a modest home in a mid-tier city. That shift, that recalibration of what 6 figures actually means, is one of the defining financial frustrations of this generation. And it is real, it's not in your head. $150,000 income, most US markets accessible. At $150K, the country opens up considerably. Austin, Denver, Nashville, Portland, Chicago all come within range, but coastal extremes remain out of reach. Austin, Texas, Denver, Colorado, Nashville, Texas, Chicago, Illinois, Los Angeles, California, San Jose, California, New York, New York. $150,000 is where the map starts to feel like a real choice rather than a constraint. Most of the country becomes genuinely accessible at this income level. But here's the footnote that deserves its own headline. San Jose, California, the heart of Silicon Valley, requires a household income approaching $500,000 annually to comfortably afford a medium-priced home under our framework. $500,000 a year for the median home in one American city. That is not a functioning housing market. That is what economists call ability to pay pricing, a market that has been bid up so relentlessly by high earners that the pricing no longer reflects any reasonable relationship to what normal people earn. The market doesn't care. It just clears at whatever price buyers will pay. And in places like San Jose, buyers keep showing up, which means the math keeps getting worse for everyone else. If you're in one of these extreme cost markets right now, you're not failing. You're facing a structural problem, and the solution probably isn't trying harder. It's thinking differently, which brings us to the dark side of that math. The hidden cost of being house poor. I want to paint you a very specific picture, not a worst-case scenario, not a cautionary tale about foreclosure or bankruptcy, something much more mundane and much more common. You buy the house, you stretched, maybe a little past the 28%, maybe closer to 35% or 38%. The bank approved you, the deal felt right,
The market was moving fast, and you didn't want to miss it. The first few months are fine. The mortgage gets paid, life goes on. And then the transmission goes on your car, or your kid needs braces, or your furnace dies in February, or you get a medical bill that your insurance only partially covered, or your company does a round of layoffs and your income dips for a quarter, or all of the above in the same 18-month stretch, because that is what normal life looks like when you're paying attention. And every single one of those moments, you will feel the weight of that mortgage payment sitting at the top of your budget, immovable, non-negotiable, first in line every month before everything else. We call this being house poor, and it is far more common and far more damaging than the dramatic financial disasters that make the news. It doesn't show up as a crisis. It shows up as a slow, grinding erosion of everything that was supposed to make financial progress feel real. The deferral spiral. When the mortgage comes first, and it always comes first, retirement contributions get cut, emergency funds get raided, car maintenance gets deferred, career risk-taking becomes impossible because there's no margin to absorb a bad month. The wealth-building mechanisms that home ownership was supposed to enable get crowded out by the cost of home ownership itself. Let's talk about the retirement piece specifically, because it's the one people most consistently underestimate. If you spend your 30s and 40s in a house that consumes 40% or more of your gross income, there is almost no mathematical scenario in which you're also maxing out a 401k. Something has to give. And retirement, because it feels abstract, because it's far away, because the consequences of underfunding it don't arrive for decades, is almost always what gives. The compounding math here is brutal. $1 you don't invest at 35 doesn't just cost you $1 at 65. It costs you the dollar plus 30 years of market returns. Depending on assumptions, that's $7 to $10 in lost retirement wealth per dollar deferred. Your oversized mortgage isn't just expensive today. It's expensive in 2055 in ways that are genuinely hard to recover from. 37% of Americans cannot cover a $400 emergency expense, housing costs consuming all available margin. 7 to 10x, estimated long-term cost of every retirement dollar deferred in your 30s and 40s. 37% of Americans cannot cover a $400 emergency without borrowing money or selling something, not $4,000. $400. And while there are many reasons for that statistic, one of the most significant and least discussed is housing cost overextension. When your largest fixed expense is consuming half your take-home pay, a $400 surprise isn't an inconvenience, it's a crisis. The math makes it inevitable. I want to say something here directly because this part of the conversation can feel accusatory and I don't want it to. If you are in this situation right now, it is not a character flaw. The system, the approval process, the real estate industry, the cultural narrative that says buying as much house as possible is financial wisdom, that system is designed to get you to this place. The incentives all point toward overextension. Your job is to be the one person in the transaction who understands that the bank ceiling is not your ceiling.
The 3 levers of power. Here is what I need you to understand about the housing affordability math. It is not fixed. It is not a wall you either clear or you don't. It is a set of variables, and you have more control over those variables than you probably think. There are 3 levers you can pull, and most people only ever think about one of them. Lever 1, income. Every $20,000 in additional annual income translates to roughly $55,000 to $65,000 in additional home buying capacity. That means a promotion, a job change, a meaningful side income, or a career pivot isn't just a raise. It's a material shift in what the housing market looks like for you. This is the lever most people think about, and it's a real one. But it's also the slowest to move and the one you have the least direct control over on any given timeline. Salary doesn't change on a 2-month horizon, so let's make sure you know about the other 2. Lever 2, down payment. The down payment lever is one of the most underappreciated tools in the affordability conversation. Let's make it concrete. For a household earning $100,000 a year, buying a $350,000 home, at 5% down, your monthly PITI payment pushes your housing to gross income ratio to around 34%. That's above our 28% target. You're already in the yellow zone before you've bought a stick of furniture. Move to 20% down on the same home, and that ratio drops to approximately 29%, much closer to target. Your monthly payment is lower, you've eliminated PMI entirely, and your financial breathing room expands in ways that compound over time. A 20% down payment doesn't just save you money on the mortgage, it fundamentally changes the risk profile of your entire financial life. This means that in many cases, waiting longer to buy, accumulating a larger down payment while renting, is not a failure. It's a strategy. Renting isn't throwing money away. Renting while building a down payment that will unlock a sustainable mortgage is one of the highest ROI financial moves available to someone in their late 20s or early 30s right now. Lever 3. Geography. This is the one nobody wants to talk about, and I understand why. It touches identity, community, family, career. Moving isn't a spreadsheet decision, but it may be the single highest impact lever available to you, and it deserves a serious conversation. Let's use a concrete example. A software engineer in San Francisco needs a household income approaching $400,000 to $450,000 to comfortably afford a median-priced home in that market under our 28% framework. That same software engineer, with the same skills, the same salary, relocated to Indianapolis or Columbus or Raleigh or Pittsburgh, needs an income under $100,000 to access the same quality of home, in the same quality neighborhood, with the same quality of life by most measurable metrics. The income requirement drops by over $300,000. That is not a rounding difference. That is a completely different financial life. Remote work changed the equation here in ways that are still being absorbed. For a meaningful portion of the workforce, geography is now a genuine variable, not a fixed constraint. If you have location flexibility and you haven't seriously modeled what your financial life looks like in a different city, you are leaving one of your most powerful levers untouched. The reason the geographic lever is so powerful is that it doesn't just reduce your required income. It changes your entire cost structure simultaneously. Lower housing costs mean more capital available for investing. Lower cost of living means your dollars go further on everything. The same salary in Indianapolis accumulates wealth at a meaningfully faster rate than the same salary in San Francisco, simply because the denominator, your mandatory spending, is so much smaller. None of these levers are easy. I'm not standing here telling you to just earn more money, or just move cities like those are simple instructions, but they are the real variables. They are where the math actually lives. And if you're not thinking about all three simultaneously, you're probably not seeing your full set of options.
The wealthiest approach and the close. I want to close with something counterintuitive, something that doesn't make for a great Instagram post and will never trend on financial Twitter. The wealthiest approach to buying a home is to buy less home than the bank says you can, not out of fear, not out of pessimism, out of an understanding that the mortgage is not the destination, it's the vehicle. And a vehicle that consumes all your fuel before you get anywhere isn't freedom, it's just expensive transportation. The target ratio. Aim for 20 to 25% of gross income on total housing costs, not the 43 to 50% your lender will approve, not the 35 to 38% that feels manageable. The gap between what the bank permits and what you choose to spend, that gap is where retirement gets funded, where emergencies get absorbed, where you can take career risks, make job changes, weather bad years, and actually participate in the upside of your own financial life. The unsexy wealth habit, the one that actually moves the needle over a 30-year period, is margin, financial margin. The ability to absorb a bad month without panic. The ability to invest when the market drops instead of just watching it. The ability to say yes to an opportunity because you have runway. A dream home built on a 45% DTI mortgage doesn't give you margin. It gives you a beautiful kitchen and a life lived at the edge of financial solvency, where every unexpected expense is a small crisis, and every career setback is a potential catastrophe. Year 1 to 3. The house feels worth it. The space, the stability, the pride of ownership. Monthly payments are tight but manageable. Year 5 to 8. The deferrals have stacked up. Retirement contributions are behind. The car needs replacing. The roof costs $18,000. There's no cushion. Every decision is constrained by the mortgage. Year 15 to 20. The peers who bought less house, invested the difference, and preserved financial margin have caught up, and in many cases passed you in net worth. The dream home is now the reason you can't retire when you want to. That timeline plays out quietly and visibly in thousands of households right now. It doesn't make the news. The foreclosure crisis made the news. This just shows up as working longer, retiring later, and never quite having the financial freedom you thought home ownership was supposed to deliver. Here's the line I want you to remember. Write it down if you need to. Put it on the screen of your mortgage calculator app. A dream home is a nightmare if it requires you to work until you're 75. The goal was never the house. The goal was the life you were going to live inside it. The backyard dinners, the school mornings, the space to breathe and grow and actually be present. None of that requires a house that consumed your financial margin to purchase. Live in less house than the bank says you can. Invest the difference, protect your margin, and let the people who maxed out their approval letter explain to their financial advisor at 62 why they still have a mortgage and no retirement savings. You now have the framework. Use it. If this was useful, subscribe. We put out a new video every week on making the financial decisions that actually compound over time. Drop your city and your housing situation in the comments. I read every single one, and I'm genuinely curious what the math looks like where you are. I'll see you next week.